Welcome! In this session, we will cover the value at risk. Value at risk, also known as VAR, is a general measure of risk developed to equate risk across products and to aggregate risk on a portfolio basis. Value at risk is defined as the predicted worst-case loss with a specific confidence level, for example, at 95%, over a period of time, for example, 1 day, 1 month, or 1 year. For example, every afternoon, JP Morgan Chase takes a snapshot of its global trading position to estimate its daily earnings at risk, which is a value at risk measure defined as the 95% confidence worst-case loss over the next 24 hours due to adverse price moves. This definition of value at risk uses a 5% risk level. You would anticipate exceeding your value at risk amount only 5% of the time, or 95% of the time you expect to lose less than your value at risk amount over a 1-day horizon. We will now learn how to calculate the value at risk of one position and two positions by applying the concept of volatilities and correlations. The following examples of how to calculate the risk of one and two positions illustrate the basic concept of parametric value at risk estimation for linear instruments. The general steps for calculating value at risk are: Step 1. Set value at risk parameters, the probability of loss and confidence level, time horizon, and base currency. Step 2. Determine market value of each position in base currency. Step 3. Calculate the value at risk of individual positions given market volatilities. Step 4. Calculate portfolio value at risk given correlations between all variables. Value at risk can be estimated as follows. Value at risk equals the market value multiplied by the price volatility. We will generally use the term volatility to express a multiple of standard deviation, depending on our chosen confidence level for value at risk. For example, a confidence level multiple multiplied by the standard deviation. Therefore, if we are using a value at risk confidence level of 95%, volatility will refer to 1.65, and this comes from here, multiplied by the standard deviation. Let's illustrate this with an example of value at risk of a single position. You have the following information. The monthly return standard deviation of Walmart is 5.04%. You have to assume a 95% confidence level, and you have to assume that there is $1 million investment in Walmart. So the question is, what is the 95% worst case loss over a 1-month period? To estimate the value at risk of this single position, first you have to choose a probability of loss, so you set it on 5%. Then you have to measure the value in US dollars of your investment, and as we said in the last slide, we are assuming a $1 million investment. Then we have to calculate the 1-month volatility, so we compute the multiplication of 5.04%, this is the standard deviation, multiplied by 1.65, and we got a volatility of 8.32%. This 1.65 comes from this choice of probability of loss, this 5%. Then we have to calculate the risk, so we multiply the investment, $1 million, by 8.32, which is the volatility. And we got a value at risk for 1 month of $8.32 million. Now let's go to our Excel sheet and illustrate the value at risk on a 2-asset portfolio. Well, we are here on Excel and we are ready to compute the value at risk for our 2 assets portfolio. So let's begin with the first step. The first step says we have to choose a confidence level. We choose a 95% confidence level. and this will represent a C value of, let me see, norm.s.im returns the inverse of the standard normal cumulative distribution. We're going to use this function to get the 1.65. You can see that where this 1.64 comes from. Now we have to measure the value in US dollar. We are going to assume that our portfolio has a value of $1 million at the moment that we are computing the value at risk. Now we have to compute the volatility of the individual assets from Walmart, Domino's Pizza, and also the volatility of the portfolio. Let's do that. So we have to, well, firstly we have to compute the weights, or let's go to bring the weights to this sheet. We're going to use the weights of the optimized portfolio. Do you remember this from the Sharpe ratio and the portfolio optimization of the two assets portfolio? Well, we optimized this portfolio with a weight of 39.9 for Walmart and 60.1% for Domino's Pizza. Now let's look for the standard deviation of Walmart, of the individual asset of Walmart. We can look for it, and here it is. The standard deviation of Walmart is 5.04%. The standard deviation of Domino's Pizza is 5.07%, and the standard deviation of the portfolio was, let me see, 4.4%. So you gain something when you diversify. The standard deviation becomes lower. Now let's see the value at risk of the portfolio. The weight will be the sum of these two, as we are using 100%. So we got 1 there, and now I think we can compute the volatility. So do you remember the volatility equals this S value of the normal distribution, 1.64 for a 95% confidence level. I'm going to fix this cell, multiply by the standard deviation. In the case of Walmart, it is 5.04%. Now I can copy paste this for Domino's Pizza, 8.34%, and for the portfolio, 7.27%. Now we can compute the risk, the value at risk for 1 month. We have to remember we are using a monthly standard deviation, so we are computing the value at risk for 1 month and at a 95% confidence level. And we are going to multiply the value of the portfolio, or in this case the value that we are investing in the individual asset. So it will be 1 million multiplied by the weight multiplied by the volatility. So the value at risk for Walmart, if we were only investing in Walmart in one individual asset, would be $33,000 by month. The value at risk by month at a 95% confidence level. Let's do the same for the blue one is the one that I have to fix, this $1 million. Let's do the same for Domino's Pizza. I copy and paste this cell, and we can see that for Domino's Pizza, the value at risk, if we were investing only in Domino's Pizza, the 60% of the $1 million would be around $50,000. So that's the value at risk for 1 month at a 95% confidence level. What would be the value at risk without diversification? If we invested in these individual assets and not in a portfolio, well, it will be the sum of these two value at risk. It will be around $83,000. But what will happen if we had a 2 assets portfolio? If we invest in a 2 assets portfolio, then the value at risk of the portfolio will be around of $73,000. So we can illustrate here the power of the diversification, because we can see a difference of 83,000 minus 73,000 of around $10,000 of difference. So there is less value at risk when we diversify, and that's what I want to highlight in this lecture. With this, I'm finishing this lecture, or we are finishing this lecture, and in the next one, we will illustrate the value at risk for a 10 assets portfolio. Thanks for watching.